Hello everyone, Andy here. Welcome to the Crypto Wealth Cafe, brought to you, of course, by Dacxi, powering a serious crypto wealth for serious crypto wealth investors. It is time for our weekly look at the markets. Time to put the kettle on, pop down the shops, go to your local cafe. Who knows? Are you at your cafe? Order yourself a flat white, long black. I like a long black. Short black? Maybe. Also stimulating, relaxing cup of tea, even green tea. Or if it is after dark, of course, you have my permission to pour yourself a strong drink because it is, well, it's one of those times in the markets, really, isn't it? Anyway, let's get on with it. All right, let's start over here at CoinMarketCap. .com, as we like to do, and we can see Bitcoin, well, back under $30,000, so yeah, 29,591, and Ethereum back under 2,000 US dollars. Not a huge amount of movement since last week. I mean, we are slightly down roughly from where we are exactly a week ago, but really we have really just been kind of in this range for the last 7 days or so, after, of course, the big Luna UST stablecoin implosion really did tank the market. So, of course, this has been reflected in the Fear and Greed Index, which is still, unsurprisingly, an extreme fear. 11 out of 100. I think we got as low as 8 last week, and that is as low as it's been since really March 2020, the first, well, that was the COVID crash, of course. So, yeah, I mean, obviously, market sentiment not good at the moment, which is what you'd expect in... If not necessarily the depths of a bear market, it's a bit too soon to say that, but certainly well out of the bull market and into the bear market at the moment. So on the Bitcoin chart, well, it looks like this at the moment. And yeah, you can see after that sort of, yeah, this is the dump that we talked about from around 40,000 US right down to as low as around 26 at one point, and now, but we're just kind of, we've stabilized for now, not doing much, just pottering around at the kind of US $30,000 level. Now, regular viewers will know I do enjoy a Dave the Wave chart. So here's a chart from Dave yesterday. He says, how long will the Bitcoin bottom last effectively on the basis of the trend so far, and looking at what has happened in the past. So if we can see this chart here. So this is where we are at the moment, and so this box, if you can see that box, Dave is projecting that's roughly potentially the bottom area for this cycle for the Bitcoin price, which is somewhere in the region of anything from 24,000 to 28,000 US roughly, shall we say. And if you look back in the past, so this bottom here back in 2015, that range, the range while Bitcoin was at that bottom, that range lasted 243 days, so quite a long time that Bitcoin was in that bottom back there. Of course, that is some time ago, and then Bitcoin started to climb up the channel. And of course, it resulted in the glorious bull run of late 2017. Right up to the top of the channel, and then boom, well, we crashed again, didn't we? So eventually Bitcoin found a bottom a year or so later in 2019. So that's here, and you can see that this kind of ranged around in this bottom for 120 days. And then, of course, boom, we shot up again. Until COVID hit and we crashed, and then the glorious bull run of 2021, back up to the top of the channel, and forward back to the top of the channel, and well, it's been downhill ever since. So I suppose Dave is just saying, we're approaching the bottom now, but there's not necessarily any rush, because we could be ranging around the current price level for some time. It could be months, in fact. So it'd be interesting to see, of course, how this all plays out. Now, I had this thread earmarked simply because so Josh Wolf is he's the co-founder of Lux Capital, and he's extremely articulate in terms of financial markets in general. Not specifically crypto, not specifically macro either, but a little bit of everything. And some of the best fund managers over time, they write these quarterly reports for their LPs, for their fund investors, and they always, they like to have a thesis as to what they think is going on, and they'll write these epic reports. They're not really reports; let's call them theses. Is that a word? Is there a plural for thesis? Think of it as a thesis for what is going on, and yeah, I always enjoy reading them because the use of language is often quite flowery, but really well done, and often packed with wisdom and insight, shall we say. So this one is no different. It's called Survival is a Necessary Precondition for Growth. It's the Lux Capital Q1 2022 letter to their fund investors. So I just pull out some of the key points which Josh has nicely put into a thread for us, and you'll see what I mean just with the use of wonderful use of the English language, I think. And there are some insights in there, so we'll just see what we can find. So Josh says, we've reached an entropic apex. There's been high pressure to act amid quotidian chaos. And despite how easily recent fortunes were made, historically, they've been more quickly destroyed than accumulated. The analogy, of course, being that the child meticulously erects a tower of blocks, and then the swipe of a sibling swiftly erases it. So it's just a few sentences there, but it just really does describe financial markets this year, doesn't it? But he talks about human ingenuity always building in face of second law, and the world really did take stability and growth for granted, piling ever higher valuation on less compelling stuff, and this reached an apotheosis of buying incandescent pixels for millions on the square. It's natural to want to smash a broken pot. So when he says that, I mean, I take that to heart a little bit. I think he's talking about NFTs when he says the apotheosis of buying incandescent pixels for millions on the square. That sounds like overvalued NFTs to me. All right. So what else have we got in here? He says there are all kinds of firsts that are possible to explain but impossible to experience vicariously until endured viscerally. Wow, just wonderful, wonderful language. Highs and lows, love and loss, joy and pain. And Josh says that millions of people are experiencing just these such feelings for the first time. And he points out here, he's saying, in Q3 last year, we wrote in this very same quarterly letter, and I think I might have even mentioned it on here on the Crypto Wealth Cafe in one of those early episodes, but he talked about the importance of having heightened humility in these seemingly good times, and there being an observable excess of excesses. And, I mean, yeah, he was exactly right. So he was kind of calling potentially this market correction or crash, bear market, however you want to characterize it or frame it. Yeah, they were certainly pointing to this coming in Q3 last year. So yeah, I think I'll just leave it there in terms of reading from the wisdom of Josh. If you want to read the whole thing yourself, I mean, you know, I recommend it if you're interested in markets and investing and how some of the really smart minds think about this stuff. You know, I talk about always at the beginning of the show putting the kettle on or pouring yourself a stiff drink, something like that. Well, I recommend that if you're going to read through this letter. It is long, but he's done, you know, this, so you can find this either on Josh's Twitter or just search the Q1 Lux Capital Quarterly Letter 2022, of course. And this one that's been highlighted, I think these highlights are made by Josh himself. So you can see It is really long, and I was really just scratching the surface in terms of the language and wisdom contained within. But enough about that. Let's move on. So I thought this was interesting. This guy, Jason, he is the founder of Sundial Capital Research. He says that just in time to capitalize on your worries and make your weekend miserable. Well, it's the middle of the week at the moment, so let's say make your middle of the week miserable. Journalists published over 3,700 articles about the bear market just last Friday alone, and there's only a single day in the past decade, which was it was the COVID crash day, in fact, when S&P 500 dropped nearly 10%. That's the only day in the last decade that we've had this level of fear in the media. So quite incredible. The daily number of news articles mentioning the bear market. So that's the high in the COVID crash of 2020. And this was Friday last week. 3,700 new articles about the bear market. So I thought that was interesting. So I put bear market into Google Trends, and sure enough, you can see in the last year it's been, it reached a peak just last week. So I don't know if that's a good thing. I wonder what happens if we zoom out to 2004. Well, boom, see, this perfectly matches that same data. So you can see this peak was March, if we can get a date on it, but you can see that's effectively, it's March 2020. There you go. March 2020, when COVID announced its presence, the world officially went into a pandemic and all financial markets absolutely crashed. I remember that day viscerally, to use a word from my old mate Josh there. And to be fair, I mean, the doom and gloom felt that day, man. I mean, you talk about blood in the streets and fear running through the gutters. That was a dark, dark day indeed. So I don't think the current bear market, to me at least, doesn't feel anything like that level of misery. Of course, maybe it does for new people. I shouldn't say that. It probably does feel similar levels of misery for anyone holding Luna, of course. But anyway, you can see, signs that we're in a bear market when everyone is talking about it. I don't know. So I don't mean to depress you either, listeners, but you can't deny reality. You must confront reality as it presents itself to you. So really today's show is just some bear market data points, and I want to talk a little bit in a second about crypto cycles and how they work, which hopefully will present some better news, shall we say. I just read this earlier. I think we'll do maybe we'll do a show or two in the weeks or months ahead about, how to get through the bear market and how to identify the next growth opportunities, which is sort of what this blog post is about. Anyway, we'll do some more on this in future episodes. But just some wisdom at the beginning here. This guy says, I think his name's Michael Honkasalo, something like that. I don't know. Anyway, he has a Substack, so you can find it. That is his handle there. But the blog post is called Preparing for a Long Bear Market and Identifying the Next Growth Opportunities. Key point first, he says, I don't believe there's any rush to heroically start buying the dip. And, same as Dave the Wave kind of mentioned, we might stay down here for a little while. And he says the underlying forces that drive crypto market cycles mean that there's plenty of time to deploy. And given the current macro environment, there's quite a bit of variance on how low that will be. A few things that I think are true. He says long-term crypto investors aren't in a rush to sell anymore. Profits were taken near the highs and there's cash waiting to deploy. And non-native investors probably trapped themselves in buying throughout the beginning of 2022 and are still underwater or sweating. These are the marginal sellers who are left to potentially drive the prices lower. Existing crypto investors don't have the dry powder to drive prices higher or upwards into a bull market, and it's unclear when the next marginal buyer enters the market again. And that's kind of the key point. The reality is, no matter how excited we are about crypto, prices are set by the marginal buyer and seller coming into the ecosystem. So yeah, it's just something to think about that there. And don't forget, what sustains crypto is building cool and useful stuff. And a lot of that is traditionally done when markets are quieter, in the bear market, and all that stuff starts to come to fruition. In the bull market, cycle repeats. So the crypto market cycle is a function of building, then frustration with the market not reacting to it, and then we have a financial innovation that triggers growth. And this has been true in both, the previous cycles of crypto, 2013 to 2017 and 2018 to 2021. And we'll have a look at those in a second. In the meantime, just to add further context, apparently 82% of those surveyed by JP Morgan believe that crypto is uninvestable, at least for the next few quarters, because current state of retail investors, 58% believe we're in the early stages of the unwind, which is likely to continue. And are we in a crypto winter like in 2018? 82% say yes, crypto is uninvestable, at least for the next few quarters. So yeah, simple as that. Bear market for now. Doesn't mean it's uninvestable. I mean, anyone who did invest back in 2018, of course, has done very well. So worth keeping that in mind. So look, let's just bring up Dave's chart again. If we go back to 2018, 2018 bear market winter was sort of here really, and then reached a low in early 2019. So if you bought there, anywhere in there, even after the crash, you're still in profit. So, doesn't mean it'll happen in the future, but it probably will. It might. I don't know. We'll see. Anyway, I think you get the point. Cycles, people. Cycles. All right. Where were we? We were here. So we're still talking about cycles. Now, Chris Baninsky, he's the partner of Placeholder VC, partner there. He used to lead crypto at ARK Invest for Cathie Wood, and he wrote the book Crypto Assets, I think it's called. It's a famous book. It's one of the first crypto books I bought, in fact, back in 2018. Anyway, so what is Chris is saying? If we can just explain this. In the first crypto cycle, Chris is saying we saw some assets do, or the first time a new asset, crypto asset, has a cycle, enters the cycle, they tend to overperform to the point that they can do around 1,000x, right? So this was Bitcoin in 2013, this was ETH in 2017, and it was Solana in 2021. 1,000x, incredible. So Chris is saying this will happen again, but we don't know what that asset will be. 2025, it'll be something new, and it'll do 1,000x. And then after that, when these assets, if they can stick around and do a second cycle boom, you generally see 50 to 100x. So that was Bitcoin in 2017. That was ETH last year, 2021. Who knows, what will it be in 2025? Third cycle, these assets, if they're still around, they become part of the establishment. They do around a 20x. So this was Bitcoin in 2021. This will be ETH most likely in 2024, 25, still 20x, still nothing to sniff at. Who knows what it'll be in 2029. Fourth cycle is when markets mature, when an asset matures. So this is still 10x, nothing to sniff at either. This is likely to be Bitcoin in 2024, 2025, actually reaching maturity, which will be incredible to see. The multiples, though, says Chris, become off the bear trough. By bear trough, what does he mean? He means bottom of the bear market, roughly, the trough, which is where we are now. Not financial advice. Now, crypto markets, there's another way that we can look at this, a slightly clumsy way, but I'll see if I can make this work. So this is just the total cryptocurrency market cap. You find this on CoinMarketCap, right? So this is what it looks like on log scale. And linear scale, it looks like this. I mean, roughly similar to the Bitcoin chart, right? So early days, very hard to see, and then this is the very famous 2017 crypto bull run. Wow, it looks quite small here, because where are we now? It looks like this. The last bull run in 2021 looks much more exciting, and the fall looks much more dramatic, because there's more capital involved, the numbers are bigger, but back in the past, the same thing was happening. So if we move this back, we talked about the 2 cycles, right? Which is really kind of 2014 to 2018 and 2018 to now, roughly. So if we take this back, we go back to around, let's say, middle of 2018. So we've lost all of that. We've lost 2022, and now we can just see this is the 2017 bull market, which now looks much more exciting and interesting. And it still looks like there's not much happening in 2014. Still very flat. You can see just a tiny little bump there. But if we move this across again, so let's take this back to, say, 2016. Now we can see 2014, the same thing, a massive and extreme bull market, and then crash and correction. And this, of course, so this is 2014. It's not even visible on the chart when you go forward. So if we go back to 2019. This is 2014, not even visible, that an extreme, exciting bull market at the time. And now we can see 2017, all looking very exciting. But if we go back to the present day, even this extremely exciting 2017 and subsequent bear market looks quite insignificant. And I think in time, give it another 10 years, you won't even see where we are now. It'll look like a little bump here. In 2017, you won't even be able to see it. So that's kind of always something to keep in mind in terms of crypto cycles. But of course, there's more. There's always more here at the Crypto Wealth Cafe. So Andreessen Horowitz, A16Z Crypto, they put out a report a week or so ago. It's really a Web3 report, but there's a few pages in it that do a really nice job, I think, of talking through some of these cycles as well. Well, they certainly they paint a rosy picture, perhaps, of where Web3 and crypto is going. So I thought I'd just flick through some of these real quick, if we can do that. So they say that the crypto market develops in cycles. Price goes up, which leads to interest and new ideas and new startups and projects. And yeah, that's kind of how the cycles work according to them. This is what it looks like. Here we go. So again, remember we just looked at the global crypto market cap and those kind of different time zones, right? So, the 2014 bubble or bull market, if you like, not visible because it was so comparatively small. And then wave 2 and then wave 3. This is the 2017 bull market, still looks pretty small. And of course, this is where we are now. And at the same time as the global crypto market cap is growing, almost up to 3 trillion at its peak. Developer activity, of course, is growing as well. So you can see the number of developers almost, again, invisible in the early days, but growing exponentially over time as the prices increase. More people get involved. You can see it in startup activity as well. So just, a lot more startup action happening as people gain traction. Same on social media. In the beginning, almost no discussion of Bitcoin or Ethereum on crypto Twitter, which of course where I hang out. In 2017, this is when I started hanging out on crypto Twitter. A little bit of a buzz, but man, it really did explode in 2021, and still a lot of discussion in 2022, as you can see there. So again, you just expect these metrics to just keep on growing over the next decade or two. It's early, very early in the crypto ecosystem, the blockchain world. We're really only 13 years in. Bitcoin itself has only been around for 13 years. Ethereum for 8 or 9 years, and everything else is much newer. Again, specifically and especially Web3, which we'll talk about in a second. But so they say that these cycles appear chaotic from the outside, but they have an underlying order. The result is consistent long-term growth driven by a feedback loop between interest and innovation. And you can see the compound annual growth rate, incredible. 270% compound annual growth rate in the global crypto market cap. That's incredible. 68% growing in the compound annual growth rate of developer activity, 62% in startup activity, 83% in social media activity. Fascinating. Let's check in with some of the sectors. DeFi has grown from nearly zero to over 100 billion in less than 2 years. That's progress. That's technology innovation. Total value locked in DeFi. 250 billion at its peak. Even so, that makes, even at 250 billion total value locked in DeFi, TVL, that makes DeFi, roughly the 31 largest US bank by total assets under management. Look at, it's still tiny in comparison to any of the big boys, JP Morgan, Bank of America, Wells Fargo, Citigroup, and so on. It just means there's a lot of room to grow. Markets still need to mature, the technology still needs to mature. Man, huge opportunities ahead. Same with stablecoins. Increasing use of stablecoins demonstrates demand for a digital dollar. So you can see the growth in the use of stablecoins. Slightly controversial subject at the moment, thanks to Luna and UST, but yeah. Stablecoins, nonetheless, they represent just a tiny fraction of today's money supply. So you can see that just down here, just a little nudge. What's that? 171 million. So still a long way to go. Billion. We've seen several categories of NFTs emerge, but it's still very early days. That's right. So NFTs, very, very new, still speculative, but incredible opportunity, innovation, and excitement happening. And the NFT market remains hot, says Andreessen Horowitz, and we're beginning to see mainstream adoption. I think NFTs are one of crypto's breakthrough products, if you like, to find kind of product market fit. I enjoy this. So they put this into context with, Web3. We're talking about Web3. Web3 platforms have drastically lower take rates than the internet giants or Web2 giants of today. So, the big social platforms, Facebook, Twitter, Instagram, they take 100% of the take rate or the profits. They sell advertising, they take all the profits. YouTube takes 45% of the advertising profits, gives 55% back to creators. Apple's App Store, they take 30% of profits. It's some people view that as scandalous, of course. OpenSea, which is the leading NFT marketplace, they only take 2.5%. The rest go to creators. So you can see, on Spotify, which artists on Spotify earn a combined total of $7 billion a year. With 11 million artists, that's about $636 average per artist on Spotify. Not much. So all the big artists do well, but the small one, not really. Same on YouTube. 37 million channels on YouTube. So if you split that 15 billion between all those channels, $2.47, $2.50 per channel. Not much at all. Same 3, that's worse on Facebook. 2.91 billion users on Facebook. Wow, almost 3 billion. About 10 cents average per user on Facebook. NFTs, man, only 22,400 creators making NFTs, $174,000 average per creator on NFTs. So, it just goes to show the kind of revenue opportunities that are available to creators in Web3. Lots of incredible innovation happening in NFTs, but let's not get sidetracked. Lots of interest in metaverse virtual land. You would expect this to continue in the years ahead. Key point, of course, it's still early days for Web3. Early days, so this chart is just showing internet users versus Ethereum addresses. So this orange line here is the growth of internet users, reached 1 billion in 2005. At the moment, there's an estimated, I think, 7.5 million Ethereum users today. So that in the equivalent of internet adoption, we're roughly in the year 1995. That's how early we are. Were you using the internet in 1995? I think we might have just starting to get things like email addresses and be able to post on bulletin boards, all that kind of stuff in the mid-90s here in New Zealand. But man, it felt early. Everything was clunky and experimental. Remember the dial-up modems? That was your internet experience in 1995. So it's no surprise then that things like NFTs, DeFi, even just sending a blockchain transaction, it is a slightly clunky experience. That's because it's still early and everything needs to mature. But that's how these cycles work. We need the boom and bust cycles to trigger new waves of capital innovation and wash out the scams or the froth. You need a bear market to wash out some of the excess. Let the builders build, let the real projects shine and build and innovate through the bear market, and then reap the rewards in the bull market, and then the cycle begins again. So I think that's today's show, guys. I think it is. Thank you for watching. I hope you enjoyed that. I hope you learned something. Don't forget, we'll be back again next week with another exciting look at the market here on the Crypto Wealth Cafe, brought to you by Dacxi. See you then. Thanks for watching. Bye for now.